A single product can generate more revenue than anything else in a store's catalog, and that same product can generate meaningfully less value once every cost tied to it gets counted. Both of those things can be true at once because revenue and value get measured in completely different ways. Most profitability reviews start by asking which product sells the most, when the question that actually matters is which product contributes the most, once every cost is factored in. Those two answers frequently point in opposite directions. That product, acting like the growth engine, might actually be consuming more resources than it creates. And tracing a single cell through every layer of cost it passes through shows exactly why. Revenue comes first, and subtracting the cost of the product itself leaves gross profit standing. Take out fulfillment next, meaning shipping, packaging, and payment processing, and that number narrows again, then marketing costs. Tied specifically to that sale, narrow it further still. Five's whole four cuts is contribution. The actual portion of that sale the business keeps to run on. Plenty of direct to consumer brands post a healthy gross margin while their net profit stays thin, often landing at just a small fraction of that headline number. And one clear example makes the pattern obvious. A product carrying a strong headline margin dropped to a fraction of that. Once advertising, shipping, and returns that properly attributed to it. That product looked successful for one simple reason. The number everyone was watching never told the whole story. This isn't a story about a poorly run business. It's a story about where the data actually lives. Shopify's native profitability reporting leans heavily on cost per item data, and that single field never captures everything required for full product economics. Since shipping, payment processing, returns, and advertising typically sit outside it entirely. Independent analysis looking into this gap keep finding the same thing. That true net profit runs well below whatever the platform's own profit report claims. None of that happens because the product changed. It happens because the report itself was never built to hold the full picture, which means the product isn't failing here. What's incomplete is the measurement of it. Fixing this doesn't take more effort, it takes a different structure, one that follows a sale all the way through to an actual decision, instead of stopping at a report. That sequence runs from product to revenue to complete cost structure, to contribution margin, and finally to decision. And once contribution margin exists at the product level, four decisions shift immediately. Inventory changes first because a founder can finally see when reordering a product ties up cash that its margin can't actually support. Pricing follows close behind, letting a founder set prices against the true cost of landing the product rather than the supplier's original quote. Product strategy sharpens too, since a founder can now tell a deliberate loss leader apart from an accidental one. Marketing shifts last, and this might be the biggest one. A founder can stop pouring spend behind a product that looks efficient by one metric while losing money by another. Because a strong return on ad spend only measures how efficiently revenue got generated, never whether the sale was actually profitable. Revenue describes what customers chose, while contribution margin describes what the business actually keeps. And that structural gap between the two never stays small. It compounds with every unit sold, every campaign scaled, and every reorder paced. Until the real story finally comes into focus. The best selling product was never the problem. The system used to measure it was. Revenue tells a founder what happened, but the financial system tells them what it actually means. And the principle worth keeping is simple: scale what that system can actually explain. That's the distinction worth sitting with before the next reorder gets placed, the next price gets changed, or the next ad dollar gets spent.